Hello and welcome to the show. I am Puneet Wadhwa, and today we have with us Nilesh Shah, Group President and MD at Kotak Mahindra AMC. Hello, Nilesh, and welcome.
Thank you, Puneet Bhai, for having me over here.
The markets are enjoying themselves, swinging in the 60s since quite some time now. Is this dancing around with a clear direction making you nervous as a fund manager now?
And we are hitting a sweet spot in market where there are more buyers. It's domestic mutual funds who continue to get SI flows, whether it's insurance companies who continue to get premium income, retail and high net worth individuals who are now looking at equity far more positively, and foreign portfolio investors. The supply from IPO, QIP, OFS divestment has not yet begun. And hence, we are in a sweet spot where limited buying is positively impacting stock prices. More importantly, we are not very far away from fundamentals. We continue to remain reasonably priced, neither too expensive nor too cheap. Now, will market be looking at election result? Answer is undoubtedly yes, but they'll be more focused on FY24 central election rather than state election. One eye of the market will undoubtedly on the outcome of election 24, and it will remain a factor which will impact market movement.
So, as you recently said, the markets have entered a Rahu Kaalam. When do you see this Rahu Kaalam ending now?
My comment was that India's Rahu Kaalam starts when oil prices go higher. As of today, oil prices are in double digit, and hence we can legitimately say that our Rahu Kaalam has ended.
Okay.
In fact, this time, by importing Russian oil at a cheaper price, we have ensured that the impact of Rahu is meaningfully nullified.
So SEBI has come out with a lot of new norms for the MF industry to comply with. Do you think that the MF industry is being overregulated?
See, essentially, today mutual fund industry is 40 lakh crore in AUM and 3.75 crore unique investors. That's because we are well regulated. If we were a Ponzi scheme, which will be unregulated, we'll have our shot in the sun for a while and then we will disappear. So there can never ever be a dispute about over or under regulation. We owe our existence because we are well regulated. Second, SEBI has an open door policy. Whenever they come out with regulation, it is discussed with industry in mutual fund advisory committee, outside of mutual fund advisory committee, through public consultation. We believe if our concerns are fair and backed by data, SEBI is always there to listen to us.
Recent move by SEBI on TER, a number of reports suggest is likely to increase costs for AMCs and brokers. Do you think that this will, give a push to passive style investing more as compared to, active style of investing?
So, Puneet, by active and passive, both will coexist. Now, there is a lot of misreporting that fund managers are not generating alpha. There is one agency which has been publishing this report for last 2 decades. We have in the meantime grown multiple times. Active and passive, both funds will coexist, Puneet Bhai. If I talk about Kotak Mutual Fund across almost all our equity and hybrid funds, we have added value vis-a-vis benchmark indices over most of the periods. There are few periods where we may not have added value, but overall we are adding value to customer. And hence investors in our active funds will continue. Now, if we don't add value, then customer has all the right to move towards passive fund. So my feeling is that active and passive both will coexist.
So are the markets being over-optimistic about the global macroeconomy and how the central banks may respond to the headwinds?
So clearly markets have recovered with the assumption that inflation will come down. And all the central banks around the world and independent are saying that inflation is likely to be sticky. Now we have to see whether markets will win or central bankers will win. Today, markets have priced in that central bankers will have to cut rates. They will take rates higher, but they will not stay there for longer. And it is easier to say why markets are believing that. US has 120% debt to GDP ratio. Europe is no different. Japan is no different. Their economies have never seen higher interest rates. So can they afford higher interest rates and crush their economy into recession? Answer is unlikely. It's a battle between market and central bankers. My feeling is that central bankers will walk left and talk right. They'll keep on saying that we are not going to cut interest rates, but eventually the debt burden will push them to cut interest rates.
So how should one go about constructing a new portfolio now? What is the balance between equity and debt you suggest?
In debt now, interest rates have come down to 7 handle. We think for the time being, in the short term, rates are likely to remain here rather than go further down. Over medium to long term, undoubtedly rates will decline as globally central bankers cut their interest rates. This means you can accumulate duration product over next 3 to 6 months, which should give handsome return if interest rate starts coming down. So on debt, be overweight duration, but accumulation rather than today buy. On equity side, it's a fair value. This is time to have neutral allocation, but please keep some cash in portfolio to go overweight in case market correct. What is there are global factors, there are local factors. Globally, what will Fed do? How will Russia-Ukraine play out? How will inflation come down or remain sticky? That will have an impact. Locally, election 24, the soon those will continue to have some impact on our market. So on equity, neutral allocation, keep cash from overweight in correction. On fixed income, accumulate over next 3 to 6 months the long duration products so that you can benefit whenever interest rate starts declining.
Thanks, Nilesh, for joining us today. We hope to see you soon.
Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.